In the last lecture, I explained breakouts and fakeouts, and in this lecture, I will explain retracements and profit taking. So retracements and profit taking mean similar things. It's just a different term for looking at and understanding how the market's working. So retracement is typically when the market is sort of profit taking from usually like a nice upward movement or a downward movement. For example, as we were continuing to trade in this downward channel here, and we finally got this breakout, it's only natural for anyone that got into this trade to be considering closing out some of their positions as they're looking at their account and seeing that they're up quite a bit in profit. So you can imagine, if you're one of the larger firms and you have a heavy position on this position here, and once you entered into this trade, say for example, you're up $10 million at this point, and if you're looking at your account and you're up 10 million, you're going to be tempted to want to close a portion of it, if not the whole thing. And so we get this slight retracement, or this slight, it's like profit taking time. Okay, so once we get this retracement, the market then continues to consolidate, but then as others are sort of consolidating and unsure of which way this market's going to go, other traders are wanting to lock in more profits as well, so we get more of a retracement. Okay, so we can use a Fibonacci retracement tool, and we just take it from the lows to the highs, and this gives us several levels, the most common levels that we can expect to see a retracement to. Typically, once we see a break below the 61.8%, then we can typically expect it to move back down to the 100. So in this case here, after we had the breakout, the initial retracement was down to 38.2%. We had the consolidation, and after breaking below the 38.2%, we had a slight pause at the 50%, and then it finally went down to the 61.8, and it held on to the 61.8 for further support. And after being at the 61.8%, then we started to see the continuation from this initial breakout. So it's not likely that we would ever see any, once there's a breakout, that it would just continue to move straight up. You always see a breakout, a retracement like this, continuation, another retracement, continuation, and so on. And so all of these retracements are when traders are simply locking in profits. If you get into a position and you hold on to it for quite some time, and you're looking at your account and you're seeing, wow, I'm up quite a bit, it's only natural for you to want to sort of lock in some of your positions. And as you close some of your positions, other traders are thinking the exact same thing. So it's just market psychology. So that's why the market is going up and down, up and down, up and down. It's not just going straight up. Okay, so that's it for this lecture, guys. Thanks for watching. Be sure to watch the next lecture. I'll discuss continuations and reversals. In this lecture, I'll explain continuations and reversals. All right, so we're taking a look at USD CAD on a 4-hour time frame. And I just want everyone to focus on this area here for a second. So after we had this major sell-off, it's only natural for us to expect some sort of retracement to happen, at least in the short term, before seeing some sort of continuation, unless this data report, whatever economic report caused this major sell-off, was extremely strong and will cause it to sell off even further, and we would see more downside. But seeing this sell-off, let's take a look at how many pips it was here. So it's at roughly the 124 handle down to the 120 handle or sorry, almost the 121 handle. So that's a little bit over 300 pips. A 300 pip move is quite big in currencies. So it's only natural for us to see a retracement. And so after finding some support, we were able to retrace a little bit. And let's just zoom in on this so we can take a closer look at what's going on. So after getting the retracement, I'm just going to use the Fibonacci retracement tool on this. Okay, we were able to retrace down to the 61.8%. After retracing down to the 61.8%, we had continuation. Okay, so I'm just going to delete that. So we retraced, and from this small upswing, we had a retracement down to the 61.8, and then we had further continuation. And this area here, guys, when we had this small retracement from this downswing, this area was sort of resisted. Okay, so from this recent low, it was sort of resisted around the same area. So then after completing this small retracement and breaking through this level of resistance, we then were able to find another level of resistance, which was very similar around this particular area here. And notice that it fell or retraced back down to this level that was, so this was resistance, and once resistance is broken, it then becomes support. So you see here, as it's retracing down to this level, it's then being supported by this area here. And then we had a little bit of consolidation. So consolidation is when the market's just moving sideways. A little bit of consolidation here. And then after the consolidation, we had further continuation. And we can even just put in this level of resistance. So it was being resisted here. And after finally consolidating and breaking out of this consolidation to the upside, and we get the continuation, then we were able to retrace back down to this was resistance, and now we retrace back down to the level of support. So we're being supported again. Okay, and so we're this whole upswing, this whole trend here has a lot of continuation patterns in it, and you guys can see that. Okay, so let me just zoom out for a second here. So now in terms of reversals, okay, this trend will continue to trade in this upward trend until this major level of support is broken. Okay, and we also have the resistance along the top. So we're trading in this rising channel, and once this level of support is broken, that would be our sign of a reversal. So say, for example, we break below this, and then we might find this level of support, because this was an area where it was previously lots of resistance. It was resisted here, resisted, and then it was sort of supported there. So we might find this as a level of support, and we might get a bounce off of that. And then for us to continue to move downwards, this level of support needs to be broken. So we might see something like that. But this level here needs to be broken in order for this downswing to continue. Okay. So that's it for continuations and reversals, guys. In this lecture, I'll explain consolidation patterns. I know you guys have been hearing me say the term consolidation quite often in previous lectures. So I'm just going to explain basically what consolidation is and what it means. So let's just take a look at a few pairs here. So we'll take a look at, let's see, take a look at Aussie USD. Let's go down to a smaller time frame. Okay, so consolidation is a time when the markets are unsure of which direction they want to go. So they're sort of consolidating, they're sort of taking in the news. So this area here would be an area of consolidation. Same thing with up here. So we had some consolidation and the market was unsure of which direction it wants to go. So it's just pretty much moving in a sideways motion. And after finally breaking below these lows here, this area of support, then we started to break below, and then we were trading in further consolidation. Okay, and you guys can see that the ranges here are very similar in height as well. And I mentioned this in previous lectures as well, that sometimes the ranges tend to be similar in height. So if I were to like measure this, you can see that it's very similar. Okay, and if I were to draw this down as well, we can find more range consolidation areas. So this small area here, it was sort of consolidating for a little bit, and so that's what consolidation is all about. It's when the market is just sort of digesting the information. So whether it was like an economic report, or if it was maybe a news release from a firm, maybe Goldman Sachs made a statement or something like that. So you know, after once there's a breakout and then consolidation, the market is just sort of digesting the information. Okay, so that's what range consolidation is, guys. Okay, thanks a lot. Bye-bye. In this lecture, I'll explain what head and shoulders are. So head and shoulders is one of the most common reversal patterns that you'll see in candlesticks. Okay, and head and shoulders, the way head and shoulders works is basically it's just exactly how it sounds. So you have a head. So in this case here, let me just draw this in. So I'll just put in so this is going to be your head right here. Just change that to black. So this is your head, okay? And you have your shoulder and another shoulder. Okay, so this is what a head and shoulders pattern looks like. So price action is rising, it's sort of resisted, and then once it breaks through resistance, it then reaches another level of sort of resistance, and then it's immediately rejected. And then as price comes back down below, so this was your resistance. So once it broke through this level of resistance and it created the head, and then it was immediately rejected, and it came back down, and then it tested this same level, and that created the second shoulder. And then right after you see the second shoulder, then typically what we would see is sort of a sell-off. And this would be considered the neckline. Okay, so this is a head and shoulders pattern, very commonly seen in currencies and stocks. Okay, and there's also what's called an inverted head and shoulders. Let me see if I can find one. Here's one over here. Okay, so inverted head and shoulders is basically just the opposite of head and shoulders. So price action is falling. It's supported here. Once it breaks through support, it's then immediately rejected. It created the head and then created the second shoulder. Now, it doesn't necessarily have to be equally in height like this. Sometimes you can see head and shoulders sort of on an angle or like that. So you can have one shoulder here, your head, and then shoulder a little bit lower. It doesn't necessarily have to be perfectly in line like that. Okay, so that's an inverted head and shoulders. That's what it looks like on a 1 hour time frame. If we take a look at that on a 4-hour, so it looks slightly different, but that's what it will look like on a 4-hour time frame. Okay. So that's a head and shoulders pattern, very commonly seen in Forex, and it's a major reversal indicator. Last lecture I explained what head and shoulders was and how it's a major reversal pattern formation that happens with candlesticks. In this lecture I'm going to explain double tops, and double tops is another major reversal pattern development that happens in stocks and Forex. And so here we're taking a look at USD yen on a 4-hour time frame. Okay, now a double top is when price action is rising in a bull market. It creates a peak, and typically we would see some nice long wicks on the upside. Okay, so after it rises, creates these wicks, price action is unable to hold on to those gains, we tend to see some sort of consolidation. Now the consolidation could be horizontally, or it could be somewhat on a declining slope like this. And then right after the consolidation, we would see another retest of the same level, and price would be completely rejected again. So you see here how price action rose to these highs, started to consolidate, and then tried to make a second attempt at breaking through this level, but again was immediately rejected and created this nice wick on the upside. And typically right afterwards we would see the market start to sell off right after this rejection. Now from a market psychology perspective, something happened down below here, created this bull market, and once it hit a point where we started to see some sellers in the marketplace. Traders just are not believing that price should be this high. Okay, so but whatever caused this bull market this bull rally, this was still intact, and we were trying to make a second attempt at going higher, and with the failure to do so, that in most cases would lead to a nice sell-off. Okay, so that's a double top. A double bottom is basically just the opposite of this, where we would see price falling to lows. This could be sort of considered like a double bottom, where it made an attempt to go lower, failure. It would be nicer to see some longer wicks on the downside here, and then after retracing slightly and then trying to make a second attempt, it failed to do so, and after the second attempt we started to get more of a bullish market. Okay, so that's double tops and double bottoms. This lecture, I'm going to introduce you guys to some technical indicators. Okay, so I'm sure you guys have been wondering, what is this indicator that I've had on screen pretty much throughout the whole course? This is actually what's called RSI, and RSI stands for Relative Strength Index, and this is an indicator used for receiving confirmation. Okay, so just because like, say for example, we see like a double top, which I explained in the last lecture, doesn't necessarily mean that price action will fall right afterwards. You know, it's always good to have lots of confirmations, because what you want to do is you want to manage your risk. And I was explaining a little bit about risk management in one of the previous lectures as well, about how you should have a maximum risk of 3%. Now, if you're the type that waits patiently, and we saw this rejection, and you waited for another retest of this level to get in to go short, and you decided to put in your stop loss of about 30 pips, that would have been a very wise move. Now, we also would like to see some sort of confirmations. So one of the confirmations with this trade here is, you know, after seeing the rejection, getting a second retest of the same level, creating the double top. That's one of our confirmations. So one of our confirmations that this pair will start to sell off is that we're starting to see a double top. Now, what could also be a second confirmation? A second confirmation could be that it's testing this level of resistance. And lastly, what I like to see is some sort of indications from one of the technical indicators giving us more confirmations that this pair will sell off. So with RSI, a failure to break above the 70 zone was sort of a clue that we might start to see some acceleration to the downside, if not acceleration, at least some sort of weakness starting to appear. Okay, but there's lots of different technical indicators with MT4 and with technical analysis. Now, in order to view all of the technical indicators, you can go to Insert, and there's indicators at the top, and you just go over to Trend, and we can include indicators like the moving averages. We also have Bollinger Bands. These are all indicators that I'm going over in the advanced program. Now, we also have oscillators. So there's lots of different indicators here. I'm not going to go ahead and explain what they all are, but I'm just giving you guys some ideas. You guys can go ahead and you can try these out. You can implement them. If you want to include a MACD, you can just click on it and hit OK, and then the MACD indicator will appear below. I'll just go ahead and remove that. So I'll just go over to the indicators list, and I'll just delete the MACD. But there's lots of other indicators I can just show you. If you open up the navigator, you can also insert some of the technical indicators using the navigator in the left column. So there's trends, there's the oscillators here. Okay, so if you guys want to include momentum, you can also just simply click on it and drag it onto the screen, and then just hit OK, and that will give you the momentum indicator. So I wanted to introduce you guys to these technical indicators because it helps you making wiser trading decisions. So the more confirmations that you have that, say for example, you know, like I said before, if you're looking to go short here off of this double top and you're expecting the market to sell off, so you want to enter into a short position, you want to have lots of confirmations before doing so. You don't want to just gamble and you know, sort of think that it's just going down. Right? You'd like to have lots of confirmations. You want to scale down your risk. So the more confirmations you have, the more chances are that this pair will actually fall off. All right, so that's it for technical indicators. Thanks for watching, guys. Hey guys, okay, so in the last lecture I introduced you guys to some technical indicators. Now you're all probably wondering how they work and, you know, when to use them. And so if you guys are going to go ahead and test some of the indicators out, what I always suggest you do is do some back testing and some simulating before actually making any real trades. Now, how exactly do you back test or do you simulate? It's a good question. Well, what I always recommend doing is adding one of the indicators to your screen. So for example, what I'm going to do is I'm just going to go ahead and actually delete the momentum. So let's just say we have the RSI on the screen. Okay, now if you want to learn how to use RSI, there's lots of videos out there, but you can also just do your own simulations and backtesting and see for yourself. You know, instead of listening to someone else tell you how to use it, you can just make your own tests and see on your own. So what I recommend doing is just removing the candlesticks on screen and just focusing on the one indicator that you are trying to use. Okay, now if you were to just use, for example, RSI to place trades, how would you use it? When would you place trades? Where do you see entry points? For example, say you decided you wanted to only make trades when RSI came back above 30. So you would place a trade here. Let's just go ahead and insert. Let's just go ahead and insert a rectangle right here. So I would place a trade here. Let's just do this again. So where else? Well, anytime it crossed over 30. Well, like when it came back above 30 is what I mean, excuse me. Okay, so there and there. Now, if I were to place trades at both of those places, now what I can do is I can then bring down the candlesticks and see, and I can use the crosshairs here to see what would have happened. So if I placed the trade there, would I have been in a profitable position at some point? Right? Again, same thing. So at 30, if I placed the trade there, you know, how did the trade work out? So you can just go back in time, and this is a good exercise to just go back in time and try to spot places and areas where you might be interested in executing some trades. Okay, and then just jump forward. You can just press the right arrow key on your keyboard, and you can move forward in the present time and see how the trades would have worked out. Okay, so that's a good way to simulate. Just go back in time, and practice. Just pressing the right arrow key on your keyboard to see what would have happened. So for example, let's just try this one more time. So say for example, I'm only interested in going short once RSI hits 70. So if I went short there, there was a small little hiccup, and then we started to fall down, and so on. So then, you also have to ask yourself, where should I place my first targets? All of this stuff I'm going over in the advanced course. So be sure to enroll in the advanced course. It is still in production right now, but it will be released soon. Always check back on Udemy to see for the official release date. Okay, so that's it for simulations and backtesting. I'm going to show you some breakouts and some fakeouts. Okay, so I'm sure you guys have all heard of the term breakouts. So breakouts tend to happen when there's a breakout outside of a range or some sort of like triangle formation developing. So I'll just show you exactly what I mean by that. So if we're trading in this downward channel here, and like I mentioned previously, support resistance does tend to hold. Excuse me. But there are times when support resistance will break. And how do we know if it's going to be one of those times when the support or resistance is going to break? Well, typically when we start to see strong momentum thrusting into either a level of support or resistance, chances are it's going to break. And so here we have a breakout outside of this declining channel. And once we got this breakout, it then sort of consolidated near the top. And after consolidating for quite some time, this is on a 1 hour time frame, we have another breakout. And again, so when we start to see strong momentum picking up to the upside, that's a clue that we should not be expecting a bounce, and rather we might anticipate some sort of breakout about to develop. Okay, so these are a few breakouts. There's a lot of breakouts actually that happened here, just small little ones. So here's sort of a wedge. So the price action was starting to trade within this small little wedge, and then finally we had a breakout to the upside. Okay, lots of little breakouts here. Okay, so more channels, and then channel breakout to the upside, consolidation near the top. Okay, now fake outs are when we get a breakout, but then price action, it sort of breaks out and then it whips back into either the range that I was trading within before, or it might even fall much lower. And that typically happens when there's a major economic report that came out, and say for example the forecast was for some sort of figure to come out, and the number hit its target. However, there was some underlining information that came along with the statement that followed right afterwards, and it sort of shot it down. So there's that's where we would typically see a fake out. Now let me see if I can find some of them on the charts here. Usually what they look like, they're sort of like these long wicks to the upside. So here, you can imagine if this was in real time, we are starting to see, when we start to see this momentum picking up to the upside, we're thinking, okay, we might get a breakout to the upside. And we did. At one point, this candle was all lit up nice and blue, and it looked like we were going to get some continuation to the upside, but this price action was immediately rejected. Okay, and let's just take a look at this on a smaller time frame so we can see what exactly that looked like. So if we were trading this in real time, what would we have went through? Okay, so let's see. So shapes, rectangle. Just want to draw a little rectangle around there so we can see. And let's just go down to a 5-minute time frame. Okay, so on the 5-minute, we had the breakout, and after reaching this level here, we started to retrace quite significantly. Okay, so that retracement that started to happen quite significantly, you might want to close your trade, and I bet it's obvious that a lot of other traders did the same thing, and that's why we saw this sort of sell-off as well. So that would be considered a fake out. This is on a 5-minute, but looking at it definitely on the 1 hour, it's definitely a fake out development. Same thing around here as well. As we're continuing to trade within this range, we get this. It looked like it was wanting to break out. And unfortunately, again, this long wick for a lot of traders might have been, enough to get stopped out. So you might have lost on that trade if you were looking to go into any short positions here. So it all really depends on where you put your stop loss. Okay. So that's it for this lecture. Those are fake outs and breakouts.